On Thursday, all three major US indexes closed slightly higher, each posted modest gains. But how do we describe this situation? It felt kind of awkward, like tasting something good, but you can't swallow it and you can't spit it out either. That kind of feeling. No matter how you look at it, it just feels a little off. Looking at the intraday movement, you could really sense that indecision, that hesitation. So let's take a look first at the S&P 500, which everyone's watching. Right from the open, the S&P started to climb. At first glance, it looked strong, but it didn't go far and stalled quickly. It began moving sideways at the high, showing hesitation. It failed to keep pushing higher and never broke yesterday's high. So basically, if it had broken that previous high, then we'd be talking about something meaningful. That would align well with market expectations. Investors want the S&P to hit new all-time highs because technically the trend is still up. But the index clearly hesitated near yesterday's high. It didn't dare break through, so instead it just hovered around that level indecisively, just short of expectations. It's like the market was getting warmed up but surrendered too soon. Kind of frustrating, right? With the high so close, investors were eager to make history, but what came instead was disappointment, a missed opportunity, a sense of letdown, but still, there's hope in the market. So why did that hesitation happen during the session? Why did it stop short of breaking that high? Instead, we saw a choppy pattern here. This shows there was clear disagreement in the market. Where did that split come from? It came from the news. There was a headline that acted like a roadblock. After a relatively calm period, President Trump announced his intention to impose unilateral tariffs on European trade partners within the next 1 to 2 weeks. This shook market sentiment again. It sparked renewed concerns because this development raised the fears of rising trade tensions. So while the market wanted to climb, it was held back by caution. That hesitation returned. People didn't dare chase it, worried that a sudden negative headline might hit, so the market stayed cautious here. Plus, Israel launched strikes on Iran. This caused a major escalation in geopolitical tensions. Risk of sentiment clearly intensified. Gold surged and oil spiked. Later in the night session, S&P 500 futures dropped 1.5%. Nasdaq 100 futures fell 1.7%. So from this, we can tell the market action really left us feeling stuck, like something's off. It's hard to shake off. Something just feels missing. Also from the S&P 500's own candlestick chart, its pattern looks weak, especially over the past 3 days. It's been unusually cautious. Why do I say that? Take a look at the MACD indicator. You will see clearly MACD is showing a clear stagnation. The fast and slow lines are tangled up and flat. They've gone sideways, a clear sign of weakening. It didn't rise with the index. Even as the index hit new highs, MACD didn't follow. Instead, it showed something was off. And volume isn't helping either, pretty unreliable. There's a clear divergence. This divergence means price and volume are not moving in sync. The index keeps rising, but volume never really picks up, not even mild increases, no small upsticks at all. Volume stayed very low. Earlier on, though, look here. We can clearly see in the past, during the rally, there were volume spikes. The market used to show strong volume support. It had volume. It didn't need to be huge, but it needed at least steady increases, moderate volume. See this part? It clearly has support during the uptrend. Volume was obvious, so looking back, this rally had volume support, but right now it looks timid. No breakout in volume, very weak. So looking at the S&P 500's candlestick chart, the price action suggests it still lacks the confidence to tell the market, I'm ready to break all-time highs. That kind of energy just isn't there yet. But we can also feel from the market that although there's division, some investors here are still quite bullish. They're clearly optimistic and there's even a chance of a short squeeze. In this scenario, what might happen next? A short squeeze rally. Bears may be forced to cover shorts during a spike, driving prices higher. Meanwhile, there are other factors causing hesitation and uncertainty in the market. That's a dilemma. Take Buffett, for example, and investment legends like Jim Rogers. Where do they currently stand? They're often seen as market barometers, market leaders, and directional indicators. So what are they doing now? Buffett, for example, has been cashing out heavily, selling off stocks. He's holding cash. And Jim Rogers has been doing the same, mostly holding cash, gold and silver, with only a small portion in stocks. Moreover, he's already liquidated stocks in other regions. Only a small portion of his holdings remain in China, just a small part. Most of his assets are now in cash, so looking at this situation, it could have a major impact on the real economy. Events like black swans or other uncertainties have led those big names to act cautiously. When the market is unclear, they prefer to stay on the sidelines. What does this tell us? These investing legends, they're clearly concerned about the market. Otherwise, they wouldn't be making such big moves. This also sends a negative signal to the market, a sense of unease. So right now the market remains stuck in hesitation, still uncertain. In fact, what the market wants, especially from the S&P 500, is for it to lead the way. At this key moment, it needs to spark optimism. If it hits a new record high, it could trigger a market rally, an emotional breakout. Right now, if that indecision can be broken, it needs to come with strong volume. That would help MACD recover, push the price higher, and the MACD follows, hitting new highs together. That's key. That could fix the current technical weaknesses and correct these bearish signals. In that scenario, despite the macro challenges, the market itself still wants to move higher. There's hesitation, but the overall direction is still upward. That's what we need to understand. Although the market is currently indecisive, it hasn't shown any signs of bottoming out. There's also no clear reversal yet. So overall, the broader trend is still upward. Moving averages are still in a bullish formation, so our stance on the market is still primarily bullish. We remain bullish because from a technical standpoint, it's still in a bull market, and at this stage, we haven't seen any strong reversal signals. No signs of a peak either. So we still believe the market direction is upward. In this kind of setup, there are still opportunities in individual stocks, right? Take Microsoft, one of the seven tech giants. Among the big seven, Microsoft has stood out recently. It's been performing impressively. It broke through its all-time high, breaking past a resistance level that held for a year. That zone has been clearly breached. Moreover, after a minor pullback midway, it continued upward. We mentioned before when analyzing the Chin export, we said after breaking a historic high, as long as the volume doesn't spike significantly, we shouldn't assume the rally has ended. The uptrend can still continue. Look at the MACD indicator. There's no sign yet of a bearish divergence forming, right? As for volume, even though it hasn't picked up much, what does that tell us? It indicates investors are reluctant to sell. That's one interpretation. Why is it rising despite low volume? Because at this point, investors are unwilling to sell. They don't want to let go. The chips just aren't being sold. That's why there's no volume. People are holding. They're reluctant to sell. They believe in its long-term potential. So for now, they choose not to sell. They're not selling, so the stock keeps rising. No one's selling, so volume can increase. That's why we see this kind of low volume rally. But what is about this low volume rise? It depends on Microsoft's situation. Microsoft is heavily owned by institutions, and institutions dominate this stock. So since they are not selling, there's no large volume exit. That's why we don't see this rally ending. The bullish trend is still intact. Moving averages remain in bullish alignment, so the uptrend continues. It's still going. In the short term, don't assume the price is too high, especially if you already hold shares and feel conflicted about selling for profit. Whether to take profit now. At this stage, what should we do? Just keep holding. As long as there's no clear sell signal, we stay in the trade. Stick with it. What's a sell signal is when Microsoft's stock at high levels starts showing heavy volume. Because most shareholders now are institutions, these are big players, large institutions. If they begin to sell, you will see it clearly reflected in the stock price. It will come with a spike in volume at the top. So when that shows up, that's our sell signal. We will wait for that. Until then, hold the position. If you're holding Microsoft, don't sell just yet. Even if it breaks to new highs, that's not the time to exit. As long as no clear sell signal appears, stay in. So that's our view on Microsoft's current performance, a brief analysis. In fact, Microsoft's foundations are quite strong. Among the tech giants, it's the first to break new highs. That shows real strength and strong market confidence, so it's staying strong. That wraps our quick look at Microsoft. It's just our view, a brief interpretation. If you have other thoughts or any questions, feel free to leave a comment. Let's discuss it together. We're open to your insights.